How does the stock market work? Welcome to Be a Baby Billionaire. The stock market, a bustling network of exchanges and markets, serves as the beating heart of global finance, where the dreams of companies seeking capital and the aspirations of investors seeking returns converge. It's a dynamic platform where shares of publicly traded companies change hands, embodying the ebbs and flows of economic sentiment and corporate performance. From the storied halls of the New York Stock Exchange to the cutting-edge electronic platforms of NASDAQ, the stock market accommodates a diverse array of participants, from seasoned institutional investors to individual traders navigating their financial destinies. It's a realm where common and preferred stocks, growth and value investments, collide in a whirlwind of opportunity and risk. Understanding its intricacies, from initial public offerings that herald a company's debut to the complex dance of fundamental and technical analysis, unveils the mechanisms that drive the engine of modern capitalism. Anchored by regulation, guided by economic indicators, and influenced by market sentiment, the stock market stands as both a barometer of economic health and a stage for the drama of human ambition and emotion. What is the stock market? The stock market is a network of markets and exchanges where the buying, selling, and issuance of shares of publicly held companies occur. It operates as a platform that facilitates the trading of these shares, allowing companies to raise capital and investors to participate in ownership. For companies, the stock market serves as a vital means of raising capital by issuing shares to the public to fund various business needs such as expansion, development, research, and debt repayment. This process begins with an initial public offering, IPO, where a company offers its shares to the public for the first time, tapping into a broader pool of investors and securing significant funds for growth. For investors, the stock market provides the opportunity to buy and sell shares, with the expectation that the company will perform well and increase in value, leading to potential profits. Investors can trade these shares on stock exchanges, allowing them to buy and sell based on market conditions. Stock exchanges. The New York Stock Exchange, established in 1792, is the largest stock exchange in the world by market capitalization. Known for its stringent listing requirements, New York Stock Exchange traditionally used an open outcry system where traders made deals face-to-face, although much of its trading has now transitioned to electronic formats. In contrast, NASDAQ, founded in 1971, was the world's first electronic stock market. It is renowned for listing many technology and growth-oriented companies, including industry giants such as Apple, Microsoft, and Google. Other notable exchanges include the Tokyo Stock Exchange, the London Stock Exchange, and the Hong Kong Stock Exchange. Types of stocks. Common stocks versus preferred stocks. 1. Common stocks. These are the most typical forms of equity investment, representing ownership in a company. Common stockholders have voting rights and may receive dividends. However, they are last in line during liquidation, meaning they are paid after all other debts and claims are settled. 2. Preferred stocks. These stocks provide no voting rights but offer fixed dividends, which are paid out before common stock dividends. In the event of liquidation, preferred shareholders have a higher claim on assets than common shareholders. Growth stocks versus value stocks. 1. Growth stocks. These are shares in companies expected to grow at an above-average rate compared to other companies. Growth stocks typically do not pay dividends, as the companies prefer to reinvest profits to fuel further growth. 2. Value stocks. These stocks are considered undervalued in price and are typically established companies with steady revenues and dividends. Value investors look for stocks they believe the market is undervalued. How are stocks traded? The process of buying and selling stocks begins with investors opening a brokerage account with a brokerage firm, which acts as an intermediary between the investor and the stock market. Once the account is established, investors can place orders to buy or sell stocks through the brokerage platform. These orders can be market orders, which are executed immediately at the current market price, or limit orders, which are executed only at a specified price or better. After an order is placed, the brokerage executes the trade on the appropriate stock exchange, matching the buyer with the seller. The trade is then settled, which typically occurs 2 business days after the trade date. During settlement, the buyer receives the shares, and the seller receives the payment, completing the transaction and ensuring that both parties fulfill their respective obligations. Stock market participants. The stock market comprises various participants, including retail investors and institutional investors. Retail investors are individual investors who buy and sell securities for their personal accounts. They typically trade in smaller quantities and may have different investment goals, such as saving for retirement or education. Institutional investors, on the other hand, are entities such as mutual funds, pension funds, and insurance companies that trade in large volumes. These investors often have more resources and access to sophisticated tools and strategies. Brokers play a crucial role in the stock market by facilitating transactions between buyers and sellers. They provide trading platforms and execute orders on behalf of clients. Market makers, another key participant, ensure liquidity in the market by continuously buying and selling stocks, thus enabling smoother and more efficient trading. They help maintain market stability and narrow the bid-ask spread, ensuring that investors can execute trades quickly and at fair prices. Stock market indices. Stock market indices, such as the Dow Jones Industrial Average, are benchmarks that represent the performance of a specific group of stocks. These indices provide a snapshot of the overall market or a particular sector, helping investors gauge market trends and make informed investment decisions. Indices are calculated using different methodologies. In this system, a company with a higher stock price will have a greater impact on the index's fluctuations compared to a company with a lower stock price. In contrast, the S&P 500 is market capitalization weighted, meaning that larger companies have a greater impact on the index. IPO, Initial Public Offering. An initial public offering, IPO, is the first time a company offers its shares to the public, transitioning from a privately held entity to a publicly traded one. The IPO process involves several steps, beginning with the selection of investment banks to underwrite the offering. These banks help the company determine the initial price of the shares and assist with regulatory filings. The company then files the necessary documents with regulatory bodies like the Securities and Exchange Commission, SEC, providing detailed information about its financial health and business model. After attaining regulatory approval, the company, with the help of underwriters, sets the initial price for the shares and markets them to potential investors through roadshows and other promotional activities. Fundamental analysis. Fundamental analysis is a method of evaluating a company's financial health and intrinsic value by examining key factors that could affect its future performance and stock price. Analysts conduct fundamental analysis primarily by studying the company's financial statements, the income statement, balance sheet, and cash flow statement. The income statement provides a snapshot of a company's revenues, expenses, and profitability over a specific period, offering insights into its operational efficiency and profitability trends. The balance sheet details a company's assets, liabilities, and shareholders' equity at a specific point in time, illustrating its financial position and solvency. Meanwhile, the cash flow statement tracks the inflows and outflows of cash, highlighting how effectively a company manages its cash resources. By analyzing these financial statements, investors can assess various financial ratios and metrics such as earnings per share, EPS, price to earnings, P/E, ratio, and debt-to-equity ratio to gauge a company's financial stability. Technical analysis. Technical analysis involves studying historical price and volume data to forecast future price movements and identify trading opportunities in the stock market. Analysts use charts and patterns to understand market trends and behavior, employing various technical indicators such as moving averages, relative strength index, RSI, and stochastic oscillators. Moving averages smooth out price data to identify trends and potential support or resistance levels, indicating buying or selling opportunities. RSI measures the speed and change of price movements to determine whether a stock is overbought or oversold, helping traders anticipate potential reversals in price direction. Technical analysts believe that historical price patterns tend to repeat themselves due to market psychology and investor behavior. Market sentiment and psychology. Market sentiment and psychology play crucial roles in influencing stock market movements. Investor emotions such as fear, greed, optimism, and pessimism can drive buying and selling decisions, impacting stock prices and market trends. Positive news, such as strong corporate earnings reports or economic growth indicators, often boosts investor confidence and leads to buying activity, pushing stock prices higher in what is known as a bull market. During bull markets, optimism prevails and investors are more willing to take on risk, expecting continued upward momentum in stock prices. Conversely, negative news or economic uncertainties can trigger fear and caution among investors. Regulation of the stock market. The stock market is regulated by various governmental and self-regulatory organizations to ensure fairness, transparency, and investor protection. In the United States, the primary regulatory body overseeing the securities industry is the Securities and Exchange Commission, SEC. The SEC's mandate includes enforcing securities laws, regulating stock exchanges, and overseeing brokerage firms, investment advisors, and mutual funds. It requires companies to disclose important financial information to the public through periodic filings, such as quarterly and annual reports, ensuring transparency and accountability. Laws and regulations governing the stock market aim to prevent fraud, insider trading, market manipulation, and other unethical practices that could harm investors or undermine market integrity. Impact of economic indicators. Economic indicators such as GDP, gross domestic product, unemployment rates, inflation, and interest rates set by central banks play significant roles in influencing the stock market and investor sentiment. 1. GDP. GDP is a crucial indicator of economic health, measuring the total value of goods and services produced within a country. A growing GDP typically indicates a healthy economy with rising corporate profits, consumer spending, and business investment. 2. Unemployment rates. Unemployment rates reflect the percentage of the labor force that is actively seeking employment but currently unemployed. Low unemployment rates suggest a robust job market and higher consumer confidence and spending, which can drive corporate revenues and stock prices higher. 3. Inflation. Inflation measures the rate at which prices for goods and services rise over time. Moderate inflation is generally viewed positively for the stock market, as it indicates a healthy economy with increasing demand and pricing power for companies. 4. Interest rates. Interest rates set by central banks, such as the Federal Reserve in the United States, play a critical role in shaping economic conditions and stock market performance. Summing up, the stock market stands as a multifaceted arena where the aspirations of companies seeking growth intertwine with the ambitions of investors aiming for financial prosperity. It's a dynamic ecosystem governed by regulation, shaped by economic indicators, and influenced by human sentiment and psychology. From the bustling trading floors of iconic exchanges like the New York Stock Exchange to the digital landscapes of online brokerage platforms. Time for the soft question. Now that you are aware of how the stock market works, would you or would you not invest in stocks? Please share your thoughts in the comment section below. This will help everyone learn and grow together. Subscribe with us and learn. If you find the information in this video valuable, please subscribe and share it with family and friends. Your support will help us create many more high-quality videos like this. Please support us. Please hit the like button and the notification bell to be notified. Click on these 2 videos shown here to explore even more. The contents of this video are for educational and informational purposes only. Thank you for watching.